first one I want to talk about is the $5 Dow. Remember, each tick is $5. That's why it's known as the $5 Dow. Take a look at the moving averages that we're talking about here in the chart, but I really want to look at here is the volume. 13 contracts, 35, 38, 28, 22. Also watch the price movements as it goes up and down, back and forth. There are times the bid-ask spread is not one tick but two. So the reason I talk about this is not just the slippage. To execute in regards to the $5 Dow, it's not unusual at all to get into a trade that is a $10 move. In other words, two ticks. That's important because there's a lot of people who like the $5 Dow because they think, well, it's only $5 a tick. Well, that's true, but the facts are that price moves around so quickly on that minimum tick that price moves easily goes one or two ticks easily. So that means your normal entry is going to be at least $5 or $10. Also, since you only have 20 contracts or so, the amount of slippage in the $5 Dow is more than you anticipate, because you are seeing some price moves, all right, but if it hits a new stop at new highs, for example, it's not going to just move one or two ticks as a normal rule, because if there's 100 contracts into a stop loss, then as you can tell, if I only have 10s and 20s in regards to bid-ask spread, that means if I have a large amount of stops, then it's going to move 5, 6, 7 ticks. So my slippage is going to be much larger in the $5 Dow. So there's a reason a lot of people says, I like the $5 Dow because it has a small entry. I can use a relatively small stop loss. Well, not so much, because the slippage may be larger than normal because we have so few number of contracts that will execute. So this is the $5 Dow. Now we're looking at the NASDAQ. That's about bid and ask. You're looking at 15 contracts, 20. Within two, you're looking at 50 20s. We may actually set a new high here, and we'll see if the prices does it. It has the same potential result from time to time in regards to slippage. If there's a large number of contracts hitting a stop loss, you're going to probably have a stop loss and a slippage of easily 1, 2, 3 ticks at least, and at times much larger than that. So the slippage is based upon, as you watch this price movement here, there you are, there it is. That's why I did the recording. You just saw a stop loss and it moved up basically 5 ticks. Believe me, your fill and my fill was up here and not down here. So the slippage in the NASDAQ is about sometimes 3 to 5 ticks. So you just have to get to understand that. That's the difference between the slippage in the NASDAQ, the $5 Dow, and it's because of the small size of number of contracts at bid-ask. Now look at the difference between the the E-mini S&P. Now look at the number of contracts at bid and ask. First, at bid and ask, 400, 400. Within 2 ticks, you are looking at over 1,000, 1,200. This is one of the reasons it's relatively popular, is because the slippage is pretty small, and it's because of the number of contracts at bid and ask. Now, there's another negative to this. Let's say I have a profit target and I put it in the dome, and I've got 800 contracts basically in there in the queue. Well, your number probably 600, because if you have put this, especially if it's relatively new in regard to putting that particular profit target, that means you got 600 contracts in front of you. So it means that it has to trade several times before you're going to get executed. So in the E-mini S&P, you're going to see it trade, trade again, trade again, trade again, and then finally you may get done. So there's a big difference between the E-mini S&P. Now, saying that, there's huge volume going through, obviously, the E-mini S&P. But there's 1,000 contracts underneath here, and there's 1,000 plus more. So there's a big difference between the E-mini S&P. This is one of the reasons it's very popular, is because it has very small slippage, but the E-mini S&P has a different feel than any other markets you're going to find. This is the bonds. These are also has very large volume. 600, 700, 1,000, 700, and this is right at the new highs. It's at bid and ask, and because of that, now bid ask here is $31.25, so it requires a larger account to trade bonds. But as you can tell, this is the daily range of the bond, so it's very small, isn't it? So there are people who trade the bonds. It's very popular, but it's like I say, you're not really trading this in regards to the time of day trading that we're talking about in regards to crude, NASDAQ. Day trading in bonds doesn't necessarily mean scalping the type we do. There is scalpers, but it's a different style than what we do in the room. Now you want to see some volume? This is the note, 10-year note. 2,000, 1,000. Within 2 ticks. 6,000, 14,000. Sorry, was it 4,000? Yeah, 4,000. So this is huge in regards to bid and ask. And this is another popular contract, the 10-year note. But you get a lot of volume, all right. But again, look at the small range in regards to the number of ticks. This is now the euro, the exchange, 20, 60, 20, 50 or so. The one thing good about the euro is that it has a huge range, and you're able to trade the same styles that we use as our tick charts. Our prefer is the range charts. But this is an excellent contract. But remember, that is a $10 per tick. And this is one of the reasons that people prefer. When I say $10, it does depend upon what currency you're going to use, and whether or not you're going to use the Australian, the pound, etc. But in this particular case, this is an excellent contract. This would therefore it would be a standard contract size in regards to Forex. The beauty of Forex is you can use minis, which is 1/10 the size of a standard. The price movement, the slippage, is not too bad in the euro, except unless, of course, there is news. If there is news, currencies can really move quickly. So let's go back and take a look at the crude. On the decision of bid and ask spread, is crude one of the better trades that you can trade? As a general rule, that's true. Is crude more volatile? Probably so than some of the other markets. For example, the euro is more steady unless there's a news event. As you can even tell in this particular chart, you're looking at very fast movements of a $50 to $100 move. Therefore, it's not easy to trade in regards to crude. This is why we try to pick our spots. And sometimes I pick wrongly, doesn't it? But I could have, like I say, this could have rallied up there. It could have been a 34B, 89B, and that basically got killed. Now prices begin to move. That's the problem of crude, is that it is a beast. But the reason we have been following crude on an average day, crude currently has a range of about $1.40. That is 1,400 contracts. That's a lot of movement, and that's the reason we follow crude. If I have basically 140 ticks, I'm able to find on a normal day, not today, that there's plenty of price movement during the day. And it only takes a couple of trades to catch. That is the reason we follow crude. We have such a large number of ranges and follow our trades that we're able to find, basically make a little piece of the day. Now today is a very unusual day, that we've had this kind of price action now for 4+ hours. And that is not, obviously it's not any good. Looks like it was going to be bullish, looks like it's going to be bearish. Now it's going to try to bearish again. Who knows? So it's very difficult today, but this is why we follow the crude. Out of $1,700, we're just trying to pick a little piece of it when you have 170 ticks to play with. The bid-ask spread is not too bad. The slippage is normally no more than $10, one tick. Many times not. If there are some buy stops, however, don't be fooled by the size of contracts. If there is a stop loss, it will go through 1,000 contracts like nothing. So price can easily move 5, 7, 10 cents quickly. And the reason we know of this amount of slippage is based upon looking at the minimum bid-ask spread, and that you're looking at the price action of about 1,000. When I say 1,000, within 10 cents, you're looking at well more than 1,000 contracts, and within 2 ticks, you're looking at 100, 150 plus. Let me show you something that is a little different. This is the Spider, SPY. That's an ETF for the E-mini S&P. 20,000 shares. 2,000. 20,000 shares. This is an important, if you're becoming basically a specialist in the E-mini S&P, you need to have the ability to look at the spider. It's important because you need to look at what they're doing as well. Now, saying that, that's almost tick by tick moving around in the direction of the E-mini S&P, the ES. I'm just showing you the amount of volume there is in the spider. This is an extremely volatile price move for an ETF. Also, the amount of shares per day is huge. This is the triple Qs. That's the ETF for NASDAQ 100. What do you notice about the ETF, the QQQ? There's gaps. So obviously in the E-mini S&P and the triple Qs, obviously a ETF for the Dow it's the diamond, DIA. This is why I discussed this a little bit. If you're going to become a professional in stock indexes, you need to make sure you are watching the triple Qs or the E-mini S&P. Why? You then are able to watch this gap. Remember on the E-mini S&P and the NASDAQ, we actually saw prices come down? And you may not have known, well, why was it coming down? Because you had a gap. And we know about, quote, trying to fill gaps. That's all that was to come in here and try to fill the gap. And it's not easily seen, obviously, in the NASDAQ or the ES, but it's easily seen in the ETFs, the triple Qs, the spiders. And so you're now setting a new high. It was a new high because it was a new high for the day in the ETFs. So it's not expensive at all to add the triple Qs and the spiders, basically your stocks data. If you're a non-professional, it's cheap. And this is going to help you tremendously from time to time, being able to indicate when you have price gaps, resistance, breakouts of the day, etc. The number of shares, obviously, in the triple Qs is also very large. That's 40,000. That's 50, 70,000 shares. So it's a very important contract.